Thank you, Danny. Is everybody hearing me all right? Yeah. Okay, so this is supposed to be working well then. Although the billboard outside say case studies, this is not a case study presentation. So in case you just wandered by and thought I was going to present some financial cases on TOC, finance, and distribution environment, this is not what is this talk about. My aim here is to try to make a bridge. The bridge between the kind of assumptions and the logic we understand in the TOC distribution solution, and how can we model this impact? Is this specific logic we're thinking about something really interesting that will make an interesting financial impact in the end or not, and how? What are these avenues that when we implement things will generate results for us? And how can we try to start to evaluate their impact? So I'm going to try to spend with you half an hour. This half an hour had a buffer because it was 1 hour, then it became 45 minutes, then it became half an hour. So I hope I can squeeze it a little bit of buffer inside it and not rush this through. But the most important thing is for me to bring to you this connection between the logical assumptions in our thought process and how can we connect them to the impact of the solutions in real financial terms for the companies we're working with. So these are some questions I would like to answer in a more or less robust way. If we implement the TOC distribution on a retailer or any other type of company, how can we gauge the size of the impact in their profit? Can I use the current retailer distributor numbers to gauge this impact? What are the errors that the accounting ways of organizing the numbers will induce me or not? And which factors impact the financial result more? So if we have to focus, our attention is limited, our time is limited, the amount of battles actually we're going to fight during the implementation is pretty much limited. So which ones should we pick? And what should we expect? Because there's another issue here. As you all know, in distribution environments, we cannot afford to have a bottleneck for long. The stocks will be depleted. We'll be totally out of the whole concept of, well, having availability of stocks. So if we are inducing the sales to grow, how long until we hit a bottleneck? That's a nice, interesting question as well. And we have to connect this with the results in order to be able to close the loop and reinvest and elevate our capacity in a timely manner. So let's see how we can do this. We'll just revisit a little bit the statements, the financial statements, how the company reports, TIOE, just to put us on the same page. I'm sure you all have heard this before, but just to clarify some definitions that we'll use afterwards. Then let's see, what exactly is throughput in these kind of environments? Because as we change environments, the measure of goal units we're achieving in this particular organization can change. So in distribution, let's see exactly what that means. And if we can pinpoint this from the data companies usually use. Same thing with the investment. Actually, in this particular opportunity, I'll not have the time to talk really in depth about investment, because investment takes many influences from our solution. And there are some things, when you change the scale, sometimes rules change. So just to give you a hint, nowadays I can buy from Miguel something, and he'll say, okay, you can pay me in 30 days. So I have more or less 30 days to try to sell this to the next link. And if I succeed, great. I haven't got to have some money in my pockets just to afford this transaction. But if I take more than 30 days, I'll have to have some money in my pockets to sustain this transaction. So when you cross this barrier, rules change. Your working capital requirements change a lot. And unfortunately, in this talk, I will not have time to cover this in depth. But that's another whole chapter of how you evaluate these frontiers when you're shortening the time in your supply chain. Also, what is operating expenses? Are they really operating expenses? This is a small topic, but we shouldn't confuse things here. So I'm just taking this out of our way a little bit. Then let's see the interesting things, the financial impact of our solution and how to model it. In a simple way, we're just trying to make a rough approximation. Okay, reality will show us many more other avenues to this impact. So, okay, this is the classic definition. I basically copy-paste Ellie's work, so there's nothing new here. The throughput, investment, operating expense, or inventory and operating expense. We could say that this is understood nowadays as these concepts. So throughput is basically the rate that the system is generating new money. If we're talking about for-profit companies, well understood. Investment is all the money the system holds within it. And operating expense is all the money flowing out of the system, not dependent on the throughput. But why did Ellie wrote this differently? Because I had two key points in mind, and these key points are important for us to make the bridge in the financial models that we're going to discuss in a few moments. The keys, we're talking about real money flows or positions. What I mean about real? Real is something that really materializes in some money. So if I pay James for something, that's the real money flow. If I'm just saying, oh, I may have to pay him in the future, so I'll save this money apart, this is not a flow, right? I'll just make a provision. But I'm preparing myself for something that may or may not happen. So that's not a real flow yet, okay? Same thing for a position. If I owe you some money, that's a position I have in my book. But if I think I will maybe owe you something in the future, that's not a real position. So we need to separate these things in our mind. And also, we are talking about how do we interact with the external world. And that's the clear criteria for you to define what's real, what's not. If you are interacting with the external world, then you can easily define what is a flow. If you're not, then maybe that's not a real flow. Okay, so where do we get some data? What are companies used to work with? And unfortunately, they use the same tools for different purposes, and that creates a big confusion. So let's see the normal tools for that. The normal tools for that are the financial reports, basically the balance sheet and income statement, or P&L. And they're done primarily for taxes purposes. You have to report for external world, so they have a structure that it's optimized or thought in this direction. And when you try to adapt them to be used for managerial decisions, then maybe you're using a screwdriver to do a hammer's job or vice versa. So things may not work according to plan, and that's the source of a lot of problems. What happens? Well, Ellie pointed out some examples of that. People take shortcuts. So we go in a company, say, how much profits on sales you do today? Oh, I do 5%. Great. So if you increase your sales per 20%, how much profit you'll make? Oh, let's see. 10%, 20%. I'm going to make 2% more. Wait, there's a lot of assumptions there, right? That the ratio is the same, and that keeps on the same proportion as we change the rules that made us increase our sales. So these are the kind of shortcuts that differentiate between the managerial view of the data and the fiscal view of the data. So where are TI and OE here? Well, we're basically not talking about a second set of books. That's not it. It's basically keeping a reclassification of the same data that allow us to make correct and timely decisions. So, well, income statement, P&L, it's basically the source of the flows. So these would be throughput and operating expense. And in distribution, usually it's closer to the TIOE, but not always timely. So usually it comes after the fact. So you need to take a little bit of care in this sense. Just to take an example, this is Zara in the Inditex Group, a good example of retail. What are we looking for? We're looking for maybe our throughput is this TVC. Traditional in this area is to call cost of goods sold. Are these really the variable costs associated with each sale we do? Is this gross margin throughput? Are we putting only elements that vary according to sales here? Is the rest of this OE? We have to answer these questions, otherwise we're just mimicking a fiscal structure in our reports. Balance sheet usually is the source of the investment. If you take what you owe and what you have, you balance this, and usually you know how much money is held within the system. But the balance sheet, as one of the oldest instruments of reporting, contains a lot of tweakings and adjustments for the government and other stakeholders to evaluate your money positions. So in this sense, contains a lot of things that may mask the amount of real money that is held within the system. So in a quick and dirty way, we're talking about clean assets minus clean liabilities. How much you have, how much you don't have to put money into, which is the liabilities eventually you'll have to pay, but for now, you haven't had to put money on them. So this difference would give you a rough, quick and dirty estimation of your investment, how much money you have held within the system. But we have to take care with this clean, otherwise we'll just end up with the owner's equity, which is not the amount of money invested in the system. There's a lot of things that government allows us to put in both sides, assets and liabilities, that are not real positions. Provisions, adjustments, all kinds of things that might lead us to this conclusion that we have this amount of money while we have another amount of money, and then our decisions will be tainted by that. Hopefully by not much, but sometimes it might be significant. So, continuing on this quick example, what are we looking for? For instance, a main element for us would be to look at inventory. But is this inventory clean? Is there any elements there that are really distorting our view in inventory? Well, in industrial environments, that's for sure. We buy raw material, then we add value, then we make them into finished goods. We add more value, eventually we'll sell them. Great. In this process, the government allows us to bring from the future or from expected future some value into these things. That's not a real position. That's an expected position. And we cannot really count on that. That's not money held in the system. Is this the case in retail? Well, much less. We still have some allowances in different countries, different flexibility in this sense, but much less effect in the inventory valuation. But we have other things that influence provisions. These are the type of things that are not real in terms of a position, how much money. It's just a way of saying, you know what, I'm not putting this money back to the investor right now. I'm holding it for another purpose. Which purpose? We should know, because that's managerial. Okay? Just saying provision is nice for the balance sheet. For a managerial view, that's not enough. And something that's really important, especially in retail environments, which is what is our normal position, our working capital requirements, the difference between payables and receivables in this sense. This is also very important because as our solution increases turns and reduces the time that we have something in our link of the chain and out of our link of the chain, these may help us a lot. When we cross that barrier I mentioned earlier, when you have to receive before you have to pay your suppliers, then it's a different ballgame. You're actually maybe working with a piece of negative investment here, which means each time you grow sales in this mode of operation, you don't have to put more money. Actually, it's better for your system. It improves your cash flow. But that's a specific point. As I said, I won't have time to cover it in depth. So why do we go after this throughput anyway? Well, this is a simplified way to take decisions. Something that will clear our mind and say, yes, if I increase my throughput, I'm doing a good job in pursuing the growth objective of the company. So I need to clean this. We know that money is coming in has a component that will go out to the suppliers and third parties. So we clean these, TVC, and we end up with T. But in retailers, what do we have here is not a clear-cut picture. What can affect our view of throughput in the retail and distribution environment? In industrial companies, the price that you sell a specific SKU is basically not varying that much. You vary some percentage points above and below, 10% up, 10% down, that's okay. But in retail, which is the other extreme, that is totally not what happens. The price may vary by an extremely large amount. So what is the reference point for start to calculate throughput? Well, that varies. The same product to different channels, in different moments in time, in different packages or whatever, may be sold at very different prices. So the first starting point to calculate throughput is not as well defined as we could think of it. Okay? And the second part is TVC, which could also vary, especially you are in a distribution chain, because all the ill effects we know, okay, we overstocked, now have to get rid of all the stock. So you make what? A promotion. You're in the middle of the chain, You cut down your prices, well, your price will be TVC of the next link. So this creates waves of noise, actually, in the information, the financial information we're trying to deal with. And this complicates a little bit. So I'll try to give you some hints on how to simplify this vision and how to make it in a quick way to take the decisions on, well, am I doing a good job or not in my company? Well, cost of goods sold versus total variable cost. What's the difference? Well, we have some differences. The first one that we took from the original text in TOC is value allocation. Okay? That's important in industry settings. In retails, that's normally a chupchik in distribution as well. It's not the big amount of value added in whatever type of environment you can think of. But variation of purchasing prices, this is big. Losses, spoilages, this is also big. In many segments, many types of supermarkets, 20% losses is not extraordinary. Is that TVC? Is that OE? It's 20% of your inventory. It's not a small thing, right? So we need to think about it a little bit. It's not easy just to put all my TVC, all my sales, subtract one to another. This is my throughput. Great. Now, how can I make decision on an individual SKU level or a family of products level? That's not a clear-cut view, so we need to clean it up a little bit. And operational costs are included. Not often, but sometimes they are. So in some traditions of reporting, you put other things in the cost of goods sold, transportation and other costs that might be associated with that. It's not that common, but may happen. How can we understand throughput and keep it simple? Because if I give you this whole PhD thesis on how to calculate throughput in retail, is not going to help you. So we need to keep it very simple. And the simplest way I can put it to you is, okay, think of throughput in 3 ways. We sell things in the distribution and retail channel in 3 ways. Well, the third way is not exactly selling, but I'll classify as selling for a practical purpose. The first one, you bought it and you sold at a full price, the price you intended to sell in the first place, the price you planned for. So this is a normal sale. You put your normal markup and that's how it goes. The second one is, well, you sell it at a discounted price. The same good, the same thing you bought, but on a different time, on a different situation, you sell it for a different price. Obviously, you have a different throughput associated with that. And the third type of sell is not actually a sell. It's when you lose it. Spoilages, losses, well, whatever. These may account for a large proportion, an important proportion of your inventory outflow. Okay? So if you just split them in 3, you might have an easy way of calculating the impact of your actions. So if your actions are impacting the high runners, which of these 3 type of sales would you say it affects? Any idea? High runners, you usually sell them at a discount, you lose them, or you sell them at full price? Full price. So it's just an easy way. Okay, if I'm doing something to better my position regarding the high runners, I know exactly what type of tea, what percentage of tea over price I'm talking about. So if I split these into just 3 categories, it's pretty easy. And actually, if you don't want to mess too much around it, you can put your losses in OE and keep just 2 categories in hand. Okay? So just a quick example. We take this company. It's a closed retail, markup 100%. Wait, is this picture right? I just said markup 100%, right? If I buy something for $1, I'll sell it for $2. But we look here, throughput is 20%. Something wrong with this picture or not? Well, if you go to any retail, you're going to see this dichotomy. You have an intended markup, which implies an intended throughput percentage, but the actual real throughput is not that one, usually much lower. What happened here? It should be 50% throughput, right? What happened? We forgot this division. There is throughput at full prices, throughput at discount prices, and losses. And if we forgot to take these in consideration, we'll never make these 2 meet in the end. Or we might have the impression that we really don't have this markup, that we sell at very low margins in this. It's not the case. And our solutions change this mixed. So we have to take this in consideration. Otherwise, we'll take wrong decisions with the solutions. So quick breakdown. How do we do this? We'll break this in, well, just 2 categories to make it simple. How do we sell things at full markup? Here is just the sales price. And what is the TVC in this case? Okay, it's just half. We took it for 300, 100% markup, sold it for 600. But many things don't sell that easy. So we bought them, also for 300. And despite our best efforts, we could sell them for 400. And that's the best we could do. And this explains this gap we had between the two, right? The same thing here with losses and spoilage. These could be big. Depends on your environment. These explain why we had this difference. And if we just divide them in 2, we know now, okay, I'll implement this part of the solution. What type of throughput, what type of sales am I going to impact? Whose eyes is? Well, who owns the merchandise? When is a sales final? This is a central question. As I told you, payables and receivables blur this picture a little bit. But the fundamental thing is to say, okay, we only sell something when the chain sold something to the end consumer. But we need to recapture this. So we need to take into consideration the positive impacts of accounts receivable and the negative impact of accounts payable in our own investment. So this is also something that sometimes comes into play when we evaluate how we will implement and how we will quantify the impact of our solution. So we need to take into consideration working capital requirements. Usually we do not worry too much about it because most of the time our solution shortens the lead time in an environment. So it betters our position in terms of working capital requirements. But you have to take this in consideration. If you have too exposed position in terms of working capital, you might have to take care of this because an increased sales could put you in a very bad cash position, okay? And that could happen later on, after you're stabilized, but still are very open to working capital requirements, have a good difference between accounts payable and receivable, and you are pushing the sales to go up and up, you need to take this in consideration. Not only the raw materials, if so to speak, the cost of goods, but also the capital required to hold them for a period. Operating expenses, well, they're usually okay, but part of cost of goods sold sometimes is operating expenses and vice versa. And basically, for decision standpoint, it's useful for you to say, am I trying to analyze just the individual unit sale? Or am I trying to analyze a business unit? Or a shipment? Or a client? So in this sense, you might want to reclassify a little bit of operating expense. But this is usually a clean area for you to take care of if you clean the total variable costs before. Okay. So what is the expected impact? Let me focus on the retailer because it's the worst case in terms of differences between the normal industrial or production-oriented scenario in relationship with the financial impact. But the logic between the assumptions and the impact is the same throughout the chain. So this is the normal future reality tree you would expect. We want to what? Have high availability with low inventories, leading to good effects, more sales and increased profit. But these avenues will have different impacts. Let's try to pinpoint a couple of them and evaluate these avenues and how to gauge their impact in the companies. So let's present here just 4 models. And I'm trying to use these models to build your intuition about how to connect assumptions with financial modeling. So the first one is the less inventory model. Okay, we just reduced inventory. Is this good enough or not? By how much? Second model is, okay, we reduce shortages, but over time. So this has an impact in sales. How much? What are the assumptions behind it? Can we always be sure this will be the case or not? Less inventory plus less shortages. What will that do? And the mix. You heard Ali saying sometime during this conference that the impact of changing the mix could easily surpass all the other impacts done up to that point, which is reducing shortages and ensuring that replenishment is done properly. So what is this impact? Is there a quick way to gauge that? Some way for us to see, okay, I'll change a little bit my product mix, because now I have information and the means to do it and how much this will represent for me. Okay, so let's check. So the base model, we have to evaluate the attractiveness of a distributor offer to a client. So you are the distributor talking to a client and say, I don't know how this client operates. He's a kind of a black box to me. He may pick my product and put it immediately on the shelf. So if I really reduce the shortages, that will translate into better availability for the end customer or not. I cannot be sure of that. He's a black box, right? Even supermarkets may receive the products to the end shop, but you are not sure they're going to put it on the shelf. So you still may have stockouts from the standpoint of the end consumer. So let's check what happens there. So we take just a case. This is our case again. And our client, our distributor selling to this particular retail chain is just 1%. It's a big, actually, participation, but it's 1%. So what happens? The markup that is put on this product is 100%. The client earns is, in this case, 4%. How much more profit can we do if we take down the stockouts? Let's see, a little bit. If we just reduce the inventory, we can use something that the distributors are used to think about, which is the ratio of turns. Turns is an easy way to compare how much money you put in the system, how much money you take out of the system. So if you have 4 turns, we could argue that supposing the turns will keep the same and will just reduce the amount of money you need in order to sustain the same sales from my products, how much more money can you get? So visually, it would be like this. Today, you have 4 of whatever units, and you use 1 unit of money to sustain our sales. If we put another tip of money here, you would put another amount of money there, just 4 times. So this translated in our case is this. We have a little participation. We do our best and reduce the inventory of our client in half. So 50% was free capital. This capital, we don't know if he's going to put in our products or not. And actually, if he puts in his other products, he knows he can, in his current system, make $4 out of each dollar he keeps on his system. That's the turns measure. So for him, it's very easy to understand that. If he frees up a little bit of capital, and supposing that he will reinvest it in his own system, he knows how much he can expect out of it in each period of time. It's the turns. So we'll see here that a little participation here, well, it will grow our participation because he can get more of our clients with our products. But even if he doesn't, you'll have the same impact in profits, which is a big impact compared to our participation. But it's still small to convince some retail clients to go into this avenue. So let's explore other avenues. And just a note, this presentation is an updated version of what you have in your CDs. If you want the new version, just send me an email. I'll send it to you. It's just the 4th.
You also may want to point out you're using decimal points and commas opposite of how...
Actually, if you just open that in your computer, it's going to be converted because that's an Excel spreadsheet. So you just click it and it should be converted. But this computer, it's an Italian computer operated by a Brazilian. It will not be readable for you guys here, right? So if you just click here, it will take a little while and you'll see it's editable. And all the blue numbers are parameters that you can play with and check the formulas. They basically embody the analysis I'm doing with you here verbally of how this will go. And you play with the ideas here a little bit more. So just let me close this and get back to the presentation. So this is a base model. Shortages over time is similar, but now we're not looking at inventory reduction. We're looking, okay, if I can just improve your availability, suppose that you're not that black box that can really influence the availability of my products in your shelves, and with that, hopefully sell more. What is this impact? Well, there are 2 things we need to recognize here. First, what was already said in this conference, usually the stockouts are in the high runners. So you do have an interesting thing that is they usually sell at full margin. Second, if these guys are high runners, probably you're missing this amount of sales. And if you miss this for a period, you're going to have much more lost sales than the amount of percentage you're just looking at. So if you compound these 2 elements, just graphically. You have sales here, the inventory is going down. It's going down. Oops, I'm stocked out. And what could be our sales are not there. So one assumption we can make, and we have to test it, is that we're losing this amount of sales. By how long? Well, it depends. How long until the next replenishment comes in. So if you just take this ratio, the point in time where I get the stock out and the amount of time until we get the next replenishment, then you have some measure of how much sales you're losing. And a quick way to do it is this area. It's not 100% sure, but it's a nice way of you thinking of this. How much sales you're losing if you take too much time to correct the stockouts. And our solution impacts this in many ways. First, we already talked about the inventory. Second, we have this much less shortages. So if you're really able to impact that, not in this black box model I talked about, but really effectively impacting this, you may have something compared to this. So I'll just present this. It's OK. It's just straightforward numeric version of what just said. But you're noticing the impact is much bigger because you're compounding these two effects. Now, there is a combination of these two, which I'll skip totally because it's a straightforward numeric combination, but the results are much higher. It depends which kind of parameters you put in. And the last thing I wanted to touch just before closing, it's the improving of mix, which is a new thing that's not in your DVD. So if you want to play with this, just let me know. I wanted to present you a very simple, very quick and dirty way for you to know what will happen if you just get to the point of improving your mix. But how can you get there? You need to have information. So probably you aggregated everything in one single point, and then you know what's going to sell or not. And you look at your client's mix and say, you know what? You have this little bunch of products which actually are not selling. And I have these other products that I could substitute or present you with that will probably increase your sales. So how do we measure this? How do we model this? Let's try to see this using Pareto. Let's suppose I am a classical Pareto distribution. 20% of my SKUs represent 80% of the sales. If I do an ABC classification, the A, high runners, it's going to be 20% of the SKUs, 80% of the sales. The B are going to be 16, and the C are going to be like majority of the SKUs, but only represent 4% of the sales. I'm keeping the same power law distribution in all those three categories, right? If I just take a little piece, like 16% of the low runners, and substitute them, but I have to know by whom. And I know that if I have the aggregation point and the information, and I have a big enough portfolio so I can present you with different SKUs to put in your shelves, what will that represent? If you just follow it back and supposing the proportion keeps the same, and these guys are really high runners, they have the same proportion between SKUs and sales, and you can expect these 60% to represent just 1% of the sales. So you're probably going to lose a little bit of sales. Maybe yes, maybe not. But you're going to put 16% more SKUs in the high runners category. What will that represent if you keep the same proportion? 64% more sales. So you have a delta of 63% more sales. And that's on top of all the improvements you did before. Of course, you need to have the information. You need to have the portfolio that's bigger than your client usually carries. But that's usually very common. Just take the big brand case Ellie pointed us. 80,000 variations. A big client would carry 2,000 per season. It's doable. It's doable. It's not bad. This is just exploiting the space constraint and the cash constraint. And it's a quick way for you to start imagining it. I'm not saying you're following the Pareto exactly 20/80, but usually you're following a power law in your SKUs. And if you take the smallest tail and you know which products to put in their place, the impact is huge. So you can play also with this in a version here. And this is just a map to close it. I just did a quick map with you guys here, which is the following. You have two main avenues. Short, it's reducing inventory and keeping high availability. If you do these two, you have impacts in different ways, which is a conservative way. You could start to analyze it. And it's a less conservative way, understanding other logic of cause and effect in that, which is more realistic here. So if you go shortages, you could just say, oh, I have 10% shortages. If I reduce these, I'll get 10% more sales. That's a very, well, bottom line or a conservative view. If you take this over time, then it'll be a little bit more realistic because you're going to see what is the impact of taking too long to replenish them. Same thing with surpluses. If you reduce them, you can just start thinking about the system as a black box, multiply turns by the amount of capital freed, and then you can have a low limit of the amount of sales you can gain with the current efficiency of the system, which is a base limit. And you could also think of, oh, if I eliminate the surpluses, but not blindly, what could happen if I use the information in my favor? That's much better. And also, there are other things I'm not modeling here, which are the impulse buys, cross-product buys, freshness effect. Remember, you're reducing the time and increasing the turn, so the products will be more fresh, even if they're not a problem of expiration, but they have like collections and things like that. These could have a big impact. Mouth-to-mouth effect and so forth. These are more tough to model, but I already gave you a little bit of a hint how this works around in financial modeling, okay? So I think I'm less out of the time here, and this is the basic points I wanted to do. Throughput is not clear. You need to separate what types of throughput are really in play in distribution environment. Second, inventory or sales. Less inventory is more sales. You need to understand how and how much. Third, stockouts do compound over time. Do not forget that. And the mix. Using information to improve the mix has huge impact. That's it. Thank you very much.